What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be covering the entire landscape of the employment situation in the U.S. So we're going to talk a little bit about the JOLTS numbers, the ADP numbers, the unemployment rate, the unemployed persons, the ratio, all those things that we've already talked about. I'm going to go over it because next week is Unemployment Friday. It's first Friday of the month of November. And I'm also going to talk about some very, very important metrics related to the inversion of the yield curve and how it's moving back higher. And there's already an inversion that's happened between the 30-year and a couple. Actually, there's one spread in particular that's turned positive. And, we're going to drive correlations between that and the jobless claims and the unemployed persons as well. And also break down the recession probabilities and what is going to happen if there is a recession from an average perspective for the market. So hope you guys enjoy this video. There's a lot to unpack and a lot to go over. Sit back, grab a couple of coffee or, just tea, whatever it is that you want or prefer. And links to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the members only private videos and all these, spreadsheets and documents and stock analysis reports. Everything's going to be down with the 16% annual discount that does expire at the end of this month. And there's also a Halloween sale for the educational courses, 50 to 60% off. Coupon code is going to be Halloween. If you want to take advantage of that, link's also going to be down below. So next week, we have the ADP numbers, we have the JOLTS numbers, and we have the unemployment numbers. All three things are going to be coming out. The ADP consensus, 150,000. That's going to be that number for private payrolls. JOLTS numbers at 9.375 million, right? So this number is expected to come down from the prior increase of 9.6. Now, this number went up, right? And if you remember, when JOLTS numbers went up, the ratio expanded once again, ratio of job openings to unemployed persons, right? That's a ratio that the Federal Reserve and Jerome Powell cares about very much. And the markets did not like that at all because, well, that simply means the unemployment market or labor market is still very strong and it's still very tight. So we want this number to basically squeeze, right? In other words, come down. So in other words, if businesses are hiring less, if they have less job openings, this number is going to come down. And the Fed wants to see that. They want to see some weakness in the labor market. And I know how, messed up that can be, but they really do want the labor market to soften a little bit so that inflation starts to roll over. Now, this is going to be the employment situation. The expectations for unemployment are steady at 3.8%, no change on a month-over-month basis. 183,000 jobs potentially are going to be added in the month of October, which is almost half of the prior number. And private payrolls, 143,000. But this right here, the manufacturing payrolls, 23,000 decline. This and construction employment, those are two really, really important and leading indicators to whether unemployment is going to stay steady or not. I should rephrase. So manufacturing payrolls and construction payrolls, those are two important indicators within the overall employment report that tell us a little bit more about the economic situation, whether the economy is going to expand or contract. Because look, if manufacturers are losing jobs, if construction workers are losing jobs, we aren't building anything, right? Because manufacturing and construction is basically building stuff, right? And if that starts to break apart, then the economy could potentially slow down and there could be some contraction in the economy. Bill Ackman already mentioned that the economy is slowing down faster than what the data suggests. So very, very important number there, all right? The consensus range is pretty much negative, right? -5 to -25,000 from the prior number of 17,000. Average hourly earnings, 0.3%. Average hourly earnings year over year, 4%. Now, if you come over to unemployed persons, 6.3 million, it's been more or less stable in the last several years. Couple of years, it's been just since 2022. It's just been literally flat at under 7 million unemployed persons. That's a really, really important metric because it drives this number, right? And this is the ratio that I'm talking about and what the Federal Reserve is tracking. So right now, if you take a look at JOLTS, 9.61, unemployed persons, 6.36, because that's the number that we have here, 6.36, you'll notice that the ratio is at 1.51, meaning that for every one person, there's 1.5 job openings, right? So its job openings are more than the unemployed persons. So that, again, continues to be a very, very tight and strong labor market. But if the JOLTS numbers drops down to, let's say, 9.35, you'll notice that the ratio comes down from 1.51 to 1.47. Now, both of these things need to happen simultaneously, meaning if JOLTS continues to come down and unemployed persons continue to go up, and that's exactly what the Federal Reserve wants to see. So this is going to be that spreadsheet. You can see that if JOLTS numbers, let's say, comes down to 9 million and unemployed persons all of a sudden starts to increase, so let's say 7 million, now we're looking at that ratio 1.29. And I think this is really where the Federal Reserve wants to be. I think they need to be close to 1. So in other words, if it goes up to, let's say, 7.5 and this drops down to 8.5, we're getting closer to 1, right? And I think this is really where the Fed wants the labor market to be, so that it's at an equilibrium, and that way obviously unemployment rate is going to start going higher because there's more unemployed person. So let's say that you go up to 7.5, now you'll notice that the new total unemployed is going to increase. So let's just put that over there, 7.5, and now you've got an unemployment rate at 4.4%, right? That's higher from 3.8. If this number continues to increase, let's say that we go up to 8 million, or for example 9 million, now we're looking at 5.3% unemployment rate, which obviously is not great news, because there's going to be, if there's more unemployment, the probability of recession only increases in the future. So this is the ratio to really be focusing on, right? So right now we're at 1.51 at the moment, but this is what the Federal Reserve is going to be focusing on, and I think this is what's really going to drive whether we see a recession or not. Now, this is going to be the spread between the 30-year and the 2-year. Now, this is positive, okay? We were in the negative territory for the longest time, and quite severely negative. So you can see that, we dropped down to negative 118 basis points. So this right here was a sell-off, right? So negative 1.182% all the way down here. And since then, we have just been pushing higher. So we're back in the positive range, so 0.015%. That simply means that the 30-year is once again yielding more than the 2-year. And then in the past, you'll notice that every time, of course, we've turned negative, there's been a recession, right? There's been a recession that's followed after the inversion of the yield curve. Now, of the 6 pairs, of the 6 spreads that we need to track, and I think we should be tracking, only one has turned positive, which is the one that I just showed you, right? That's a 30 minus 2-year. Everything else is still negative, although moving in the right direction and moving upwards. So we obviously did get down to negative 100, 150 basis points, but everything now is starting to uninvert. Uninvert meaning it's now starting to move back higher, and the spreads are turning positive. Longer dated bonds are now starting to almost, again, we're not there yet, but almost starting to yield more than the short duration bonds. Only one pair has turned positive. That's the 30-year versus the 2-year. Everything else, like I said, is still in the negative territory, as you guys can see over here, right? Only this one is positive. Everything else is negative among the 6 that we track. Now, what does that mean? That simply means that, look, every time there is an inversion that's happening, right, we have seen unemployment increase, right? So if you take a look at this chart over here, this is unemployment rate on the left in yellow is the unemployment rate. And in the candlesticks, we've got the spread between 30-year and 2-year, which is now positive. But every single time, just take a look, right? This is going back as far as 1980s. We started to see unemployment increase as soon as that inversion started happening, right? Uninversion, meaning that we started to see that spread once again go back into positive territory. This is the unemployment rate. This over here, once again, you can see the spread turning negative, but then starting to push back higher, positive. What happened with the unemployment? It was really, really low, and then it started to move back higher. Same exact thing over here. I think this is 2007. There we go. Inversion and then uninversion, spread turning positive. Huge spike in unemployment that followed eventually. This over here was COVID. So inversion, then uninversion happens, right? We started to move back higher for that spread turning positive. Huge spike in unemployment. And guess where we are right now? So again, inversion here. We're on our way back to that uninversion, meaning that spread's turning positive. What's going to happen with unemployment here, right? I mean, it's possible, right? That's what history suggests. That's what's happened in the past. So it's possible that, many economists, investors, traders would expect unemployment to start moving higher here as the uninversion takes place and the spread starts to turn positive. This is going to be jobless claims. So we're not looking at unemployment rate per se, but we're looking at jobless claims. And jobless claims is one of the leading indicators for unemployment eventually, because I've done a correlation analysis of jobless claims with unemployment rate, and they both move in tandem with each other with a slight lag, because jobless claims moves faster than unemployment rate because there's more people filing for initial unemployment benefits, and then the unemployment rate then follows. So this right here is, again, you can see, as the spread turns positive, the uninversion's happening, more and more filings for initial claims and unemployment benefits. This again, same exact thing. We're starting to see that increase here. This over here, increase here as the spread turns positive. Once again, you can see the increase here, the spread turning positive, the uninversion's happening with a huge spike in unemployment benefits. And once again, we draw the same analysis here. Uninversion's happening, spreads turning positive. What's going to happen here? Are we going to see an increase in unemployment benefits? That's yet to see, right? We have to wait and see whether that happens or not. Now, we have seen a little bit of rotation since September, I guess even going back as far as since July, to a little bit more defensive market. right? So this is all the indexes, all the ETFs over here. And you'll notice that in the last 3 months, since July and since August, volatility is up 63%, right? So that's obviously higher. The 10-year yields are up 25%. And as the yields and VIX have both gone up, that's obviously put a lot of pressure on more of the sort of tech-heavy and more innovation-heavy stocks, right? So NASDAQ is down 9% since then. S&P is down over 10%. Financials, since interest rates have continued to go higher, financials and materials, and we've got, a lot of these other ones, like, for example, Ethereum and, energy. A lot of these have continued to sell off, and the money has rotated into a little bit more towards gold. Again, that's a little bit more defensive. And from a risk analysis standpoint, 15% for Bitcoin. Could be seasonality, but it is still higher as yields and volatility have continued to go higher, right? And this, again, Bitcoin's a little bit of an interesting one because there's been a couple catalysts that have driven this rally back higher for Bitcoin and a breakout over 35,000. Now, this is the chart that is going to be the chart of the day, okay? And what this basically shows us is the S&P 500 declines around a U.S. recession, because we know that, okay, if there is a rise in unemployment and if there is a contraction in the economy that can lead to an economic recession, what can we expect from the market, right? How much is the S&P 500 going to really drop in a mild or a severe recession? Now, one thing that I want to note here is that mild recession defined as those with a less than 3 percentage point rise in unemployment as they have calculated. So 3 percentage points meaning 3 percentages, right? Right now we're at 3.8. So a mild recession would be if you go from 3.8 to 6.8, okay? Anything under 7%, it would be considered as a mild recession. If you come over to the unemployment report here, you'll notice that this is the unemployment rate in the past. The only time we basically saw a mild recession was 2000, and this is going back as far as 40, 50 years. Everything else was severe because, great inflation, 10.7% unemployment rate. Great financial crisis, a little bit over 10% unemployment rate. COVID, over 14%. And right now we're at 3.8, right? So we're nowhere near close to those levels. But according to their analysis, a mild recession would be 3 percentage point increase in unemployment rate. It's going to put us at 6.8, just under 7%. Anything over that would be considered severe. So knowing that, you'll notice the majority of the times we've actually only had a mild recession, and the average sell-off in the market, right? Mild average has been 23%. But that's also, equities appear to be pricing in a mild recession, but that's also 23% has been the average return, which has been the drop. But there was one more thing, right? One more thing that I wanted to talk about is because the average has been 34. Okay, so the average of all recessions has been 34, but the mild average has been negative 23%. Severe average obviously has been a little bit more, negative 43%. And that's happened again 1937, 1973, 2001, 1929, 2007. So again, a lot of these sort of the Great Depression and the Great Financial Crisis eras where we obviously did see pretty significant sell-offs, but everything else has been kind of fitted under the mild recession category where the sell-off on average has been a little bit under 25%. So I think the question really we need to ask ourselves is, number one, is the U.S. economy going to enter a recession, right, if unemployment starts to go back higher, given how high the rates are and the fact that they're going to potentially stay higher for longer? It's not so much that rates are going higher, it's the fact that they're going to potentially stay there for some time is what's going to be the problem. That's number one, right? Is the U.S. economy going to enter recession? Number two, if yes, how severe is it going to be? Is it going to be a mild one or a severe one? And just given how high the rates are, right, and how long it took us to get here, 16, 17-year high, there's some expectations that maybe, the recession is going to be more brutal than what we have seen in the past. So it's going to be a little bit more severe. But then again, economy continues to be very strong. But that happens prior to every recession, right? It always looks better until it's not, right? In other words, the economy continues to be strong right now. So many people are kind of disregarding, recession talk is all BS. It's not going to happen. But that's how it's always happened, right? Every single time, nobody expected initial claims to start increasing the way they did. Every time we saw the uninversion, right? The spread starting to turn positive. So it always looks better until it's not, basically. But I wanted to show you guys this 23%, mild average sell-off 34%, and severe 43%. Now, all of these represent only one thing, opportunity, right? If the market prices do come down, risk is coming down, and that's going to lead to more potential discounts and deals in the market for us to take advantage of. And that's exactly why I think it's important to be, cash heavy a little bit, because look, you can make 4 or 5% right now in money market accounts. There's plenty of online savings account that are paying you a much higher rate of return. So that's really where I'm parked for about 23-25% of the cash exposure is in there. And I will be ready to take advantage of a lot of these deals if that actually ends up happening. But even if it doesn't, the analysis for me personally is going to be off of the valuations per se, whether we do see a recession or not. If prices do come down to my fair values or lower than my intrinsic values, we'll be looking to pick up more shares and we'll be dollar cost averaging into the Vanguard ETFs, diversified broad-based ETFs and index funds regularly, regardless of whether we do see a recession or not. Maybe a little bit more aggressively if you do see, prices come down below the intrinsic values. But nonetheless, I think this is going to be, a lot of noise over the next 6 months, maybe, whether we see a recession or not. But the bottom line is, I'm going to be trusting the process and sticking to the plan of dollar cost averaging consistently over time. And we'll be looking at, a lot of intrinsic values and whether stocks are trading below them or not. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. The two questions that I think we need to answer right now, and I would love your help on this as well, is whether the U.S. enters a recession over the next 6 months. And if so, how severe do you see it being, right? Mild, severe? Let us know in the comment section down below. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. 16% annual discount. And the Halloween sale right now for education courses is live. Coupon code Halloween. And you get 50 to 60% off on the education courses. Lifetime access as well. So always happy investing. I'll see you all in the next video.